Leverage is going to be another term that you want to be familiar with, because trading Forex cannot be done without leverage. Okay, so what leverage is funds that your broker loans you. Okay, so your broker, whoever you're transacting through, is going to loan you these funds so you're able to transact with more money. Why? Because in the foreign exchange market, as you've seen, movements are very small. So for you to make any type of considerable profit or even loss, you have to trade big. Okay, and unless you have big capital, then it's not going to be worth it. Which we've talked about. You're not going to buy it for $100 worth and expect to make money. It won't work. So you need to borrow huge funds from your broker, trade with that, so your trades have bigger impact. So brokers can loan you huge amounts. Okay, they can loan you up to 1,000 times your money, which is crazy, right? You don't get that in stocks. You don't get that in other markets. Just in the FX world that you have such high leverage. Now, it's not because you have access to 1,000 times your money that you should get that. You know, different brokers are going to give you different types of leverage, but we'll talk about more of that later. For now, what you need to understand is when your broker tells you, and when we go to look at brokers, you'll see that each broker has a different leverage number that they'll give you. This is how you read it. When you see leverage 1-to-1, that means you're not getting anything extra. Okay, it's your own capital basically, which no forex broker gives you that. Okay, what would 1-to-1 mean? It means that your margin requirement. Margin is how much money you have to put in to get the amount that you're gonna trade. Let's say you want to trade for $100,000. Well, if the margin is 20%, that means you have to put up $20,000 of that $100,000. So it's the margin required to trade all that capital. In this case, the margin requirement is going to be 100% because you're not getting any help. So if you wanted to buy one lot, you would need to put up $100,000, right? Depending what the base currency is. Now, if you get 2-to-1 leverage, what this means is that we're giving you one extra for each one that you're putting in. Okay. In this case, your margin requirement is going to be 50%. So you need to put 50% of the money. The broker puts the other 50%. And in this case, buying one lot would require you to put in $50,000 because they're putting in the other $50,000. Now, if you were trading stocks, the maximum leverage they would give you would be somewhere around here. So with stocks, if you have something that's very risky, they don't give you any leverage. It's 1-to-1. If it's, okay, safe, they give you 2-to-1 leverage. Now, if it's very, very, very safe, they'll give you like somewhere around the 3-to-1 leverage, okay? But that's it. It doesn't go over that. But you see here that with FX, the leverage is crazy that you can get. So then if you can get 10-to-1 leverage, then you only need to put 10% of the margin requirement, meaning for a $100,000 position, you only have to put in 10K. 50-to-1, which, any broker in FX is going to give you at least that. Well, you only have to put 2%. So you can literally put $2,000 in and trade $100,000 worth of a position, which is huge. Okay. You can get 100-to-1, which in this case, you put 1% of the capital, requiring you to put $1,000 for a $100,000 lot. You can get 200-to-1, which a lot of brokers have that as well. Now you have some crazy brokers who give you like crazy leverages, which we'll talk more about that later. But in this case, you can get 1,000-to-1, which it's not because you can get it that you should use it. When we talk about risk management, we'll talk about this specifically. But in this case, you will only have to put 0.1% and the broker will give you the other 99.9% to buy that position. So for a $100,000 position, you only need to put $100 in. And for this to make sense, imagine this. I'll go here on Trading View real quick. Just bring it up here. Here we go. And if we were looking at the same currency here, USD CAD, if you put up $100 and use 1,000-to-1 leverage, meaning you get $100,000 so you can buy one lot, we've already talked that one lot in this case would make you $10 per pip. So every pip that this moves, right, moves by a pip, you make $10. So in this case, if you would have, let's say, bought it here at 13350 and this currency goes up to 1340, okay, then you would have made 50 pips. So with $100, you buy one lot, it goes up 50 pips. Well, you make 50 times 10, $500. But imagine you buy it and it goes down. All it would have to do is go down by 10 pips, right? Because if it goes down 10 pips, then you lost 10 pips times 10, which is $100, which is what you put into your broker initially, and you've lost 100% of your money, just like that. So if you lose all your money like that, your broker shuts down your account, you lost your $100, they get back the money they loaned you, the 99.9%, they take it back, right? So they're not really taking any risk on you. It's just you're taking the risk. And this we'll cover in the risk management section. But it's just to understand that leverage is a double-edged sword. A lot of newbies that come into the market, they're like, okay, well, I can get this much leverage. I want this broker because it gives me the most leverage. Well, you shouldn't use this much leverage. That's too high. You'll lose all your money. So you have to do proper risk management to know what type of leverage you want to use. But more importantly, you shouldn't choose your broker based on the leverage, because you'll see that brokers who give you crazy leverages, they might not have your best interest at heart because it's too much risk. And this we'll cover more in the risk management course, but just to understand that you can get loaned huge amounts of money to trade your positions, but you have to be very careful because leverage is a double-edged sword.